being recorded.
Okay, great. So thanks everyone for joining. Obviously, you all probably seen the news that Israel has bombed Iran in a number of different bombing campaigns, and actually, um, as we're discussing this, as we're doing this, there's apparently additional rounds of bombing attacks. So there's a high risk that anything that's said on this is going to be out of date at some point in the near future, and we'll just accept that risk in doing this, and hopefully there will be some forgiveness on not knowing the future um, in any sort of reflexive or sort of reflective analysis. So the thought is that in the context of there being a manifestation of elevated geopolitical risk, which we've written about extensively and talked about extensively previously over the last number of years, it made sense to look at what's happened and then what the state of the oil market is and was immediately prior to this, to try to see what may happen going forward, as well as what opportunities may be available from our view. And importantly, this is not an offer, solicitation, or recommendation. And frankly, my short-term crystal ball is broken. We did think that there was elevated geopolitical risk from an oil perspective, particularly from the things that were happening in the Middle East. That does not mean that because we were right on that there will be other sort of correct calls about the future. The future is inherently unknowable. And so I think it's important to sort of keep that in mind as everyone shares their views on these things and as we think about what might happen here. So a little bit about what we do at Bison. We invest in publicly traded oil and gas companies. We've been doing that for just over a decade now. We've made some money doing it, which is amazing because up and through the end of May, the S&P 600 Energy Index, which is basically a small cap public index, which best mirrors what we do, was down about 72% from when we started. So maybe pretty dumb for us to focus on that area, but it's been where we've been, and we've actually done pretty well. Relatively speaking in this, much worse than the overall market, but very well versus this index and even versus larger cap oil and gas stocks. I think that is evidence that we're okay at securities analysis and also decent at figuring out sort of some of these factors that drive performance, while also, frankly, missing some or misinterpreting some, which I think is an important caveat. So we're going to get into Iranian crude supplies and risks to that crude supply, and then share some perspectives on broader oil macro inventories and supply-demand balance, and then some thoughts on various opportunities as well as signals that we're seeing in the public equity markets. So on Iran, the bulk of their production and export capacity is geographically concentrated in an area that's actually quite accessible from Israeli bombing perspective, as well as American bombing perspective, to the extent that the U.S. got directly involved in this. And from when we planned on doing this to now, while we're recording this, there's been public threats by Israel to bomb Iran's oil infrastructure, to the extent that Iran responds via attacks on Israel's population centers. And so the tangible sort of current geopolitical risk to oil right now is that Israel's bombing of Iran was so comprehensive and so one-sided, and Iran's defense infrastructure sort of collapsed so catastrophically and embarrassingly for their sort of totalitarian despotic regime, that there's a lot of pressure on that regime to respond in a significant way. Various responses have failed so far. Thought about trying to embed some sort of video on this, not quite sophisticated enough to figure that out. I guess I could have done it, but there's these videos of Iranian rockets coming up. These were home videos and not all verified, but there were enough eyewitness reports. It would be weird if there was video and it just hadn't happened. But apparently Iran tried launching ballistic missiles at Israel. The missiles came up, and then their guidance systems failed, and they fell to the ground, and I think in some cases exploded. And so there's been this failure. A lot of those missile batteries were destroyed by Israel on the ground. The air defense systems were destroyed, and then there have been bombings of a number of high-profile military and nuclear weapons related Iran regime people, as well as their nuclear facilities and various military facilities. So there's growing pressure on Iran to respond. To the extent that Iran responds, there's an increasing risk that they respond by shutting off oil shipping through the Strait of Hormuz. You can see at the bottom of this map that strait is a significant portion of total oil exports comes out of that strait. It's oil from Iran and Iraq, and a good portion of Saudi oil exports, and from the Emirates. And so it's a really important strait, and it could materially negatively affect global economies through sending oil prices much higher, to the extent that Iran does choose to start sinking ships, or just threatens to do so, and cuts off those exports. And so that has not happened yet. And there's sort of this weird consensus that this will not happen, to the point where journalists and analysts and stuff are like actively mocking that theory. The thing is that the Iranian regime does have this pressure to respond. Their proxies have mostly been disabled. Hezbollah has lost a war. Hamas is in the process of losing a war. And the Houthis have been trying to bomb Israel for some time. And unclear if they're losing per se, but they seem to have a fraction of their offensive capacity that they might have had a few years ago. And so that's leaving Iran with fewer and fewer options in terms of a large scale retaliation, which they feel pressure to do. And so we'll see what happens there, whether it's Israel disabling Iran's oil exports, or whether it's Iran affecting its regional competitors and neighbors. And so, and apparently there's now news reports that there are missiles on their way towards Israel. So we'll see in terms of like how much they can do, and maybe that's enough. Maybe Iran sends a bunch of missiles towards Israel and they're shot out of the sky, and that's it, which hopefully would be wonderful. But there is this elevated risk to disruption, and then to the extent that there isn't a physical disruption, there's also an elevated risk of sanctions enforcement or embargo or something along those lines on Iran's oil exports, as a way of sort of forcing regime change, or forcing a change in behavior, or dismantling of their nuclear weapons program, to the extent that is not fully destroyed through this bombing campaign. And you can see in this chart on the right, the Trump administration was successful via sanctions in 2019 at cutting off Iranian oil production and oil exports. And so far, sanctions on Iranian exports have not been effective. There were some secondary sanctions threatened and a few implemented, but it seemed like the Trump administration, similar to the Biden administration before them, were sort of waiving sanctions in the hope of a peaceful outcome, a peaceful resolution. The Biden administration just sort of ignored Iran's nuclear weapons program and sort of catalyzed the current problem. The Trump administration hasn't been in power long enough to really sort of throw stones at them for that, but doesn't appear to have been fully enforcing the sanctions regime that they announced at the start of Trump's second administration. But there is this threat. And so even if there's not a military outcome that leads to either Iranian or broader exports from the area being disrupted, there's still this looming sort of trade threat. And I would argue that trade threat is more real now, especially in the context of whatever response from Iran comes out, than it's been so far during Trump's administration. Also, I've started getting some messages. I know some various folks that help advise the administration and so on, and they were getting excited about some of the very recent sanctions enforcement. And so it's possible that some of the stuff, like they got some folks in Singapore in trouble, and they're starting to chase down some of the violators of the sanctions on Iran. And so to the extent that continued, there was risk to Iranian oil exports also. And that risk to Iranian oil exports is a non-military way of actually incentivizing Iran to disrupt their competitors, their regional competitor neighbors' exports, because there's this sort of cynical, petulant approach, which is if we can't export, why can they? And look, they're friends with the great Satan or whatever, and so we'll try to disrupt it. So anyway, a couple of different lenses to look at what's happening right now. I think generally the oil market, as well as sort of the analyst community, has gotten this very, very wrong. And I think there's maybe never been a higher chance of a disruption in oil exports from this area since frankly the 1980s. And so, and we saw what happened in the 70s when that happened, and you saw oil prices up nearly 10x. And I'm about to show you why I think that could happen, and why or something similar could happen, and why the setup is actually pretty similar to the 1970s. So here's a little bit of just an oil macro overview. We're coming out of a period of very low oil prices, which led to a declining rig count. Um, and we weren't yet at a point where oil production was falling globally, but we were setting up for potential significant production disappointments, starting in the US, as well as various countries that were in decline like Mexico. And then we've been seeing a number of countries massively disappoint on their oil production growth guidance. For example, Brazil, which was supposed to grow significantly last year, and I think actually declined a little last year. And various other countries that were supposed to be growth drivers and instead have been disappointing due to massive underinvestment. They say the cure for low prices is low prices, and so underinvestment leads to rising prices and eventually high prices. And it's possible that geopolitical risk and shutting off sources of supply could sort of fast track towards that rising price environment and trigger much more investment, which would be good for small producers because their equities would likely rise a lot to induce additional investment, as well as for services companies, which would directly profit from that additional investment. So there's been a lot of discussion around oil demand. Just I'll throw it in briefly here. The long-term trend for oil is that oil demand tends to grow, and it sort of doesn't matter what people say about electric vehicles or various other sort of substitution effects. Those narratives have been around literally for decades, for basically the entire period of this long-term 1% plus oil demand growth trend. And then in the midst of all of that, you're seeing massive underinvestment on the supply side, where despite significantly growing demand and despite increasingly difficult to produce oil fields, because the easier to produce oil has already been produced and refined and then burned, you're not seeing a sufficient increase in investment. And so you have this long-term demand growth, and you have this sort of anemic investment in supply, and that's sort of opening up this possibility. Frankly, this actually looks, if you zoom back to the 60s, you had a similar dynamic where you had a long period of underinvestment due to prior discoveries, and that resulted in a next 10-year period where you saw oil prices up by an order of magnitude. So just back to the probably had this out of order a little bit, but back to the demand question. So people say, oh well, China is electrifying, and India might go the way of China. And so one, if India goes the way of China, wonderful. That would be a big step up in oil consumption. And then two, if China goes the way of, let's say, Norway, which is somewhere over here, or various other Scandinavian countries, there would still be just an absolutely enormous step up in oil consumption per capita and overall. And so there's really a lot of room as countries get less poor for them to consume much more oil. And so we've seen this interesting dynamic where demand on a per capita basis has leveled out or even fallen in various countries like the US and Japan. And then we've seen enormous demand growth in various emerging markets. And there is this narrative of peak demand or so on, but when you look at it just on a per capita basis, and then you compare it to countries that have really significantly electrified and significantly moved away from oil consumption for various purposes, to a degree that would be very hard, I think, economically for emerging markets that are much poorer to be able to implement, you still see enormous potential uplift in oil demand to the tune, we're producing and using about 105 million barrels a day of oil right now in the world. And there's potential demand of close to 250 or 300 million barrels a day of potential demand if the Indias and Chinas and so on were using as much oil as some of these sort of higher demand countries. And so, even as demand is eaten away by electric vehicles and so on, there's still just so much upside from development that really, you look at China, the biggest driver isn't really electric vehicles. The biggest driver is that the Chinese economy has suffered over the last number of years. And then as it gets back into a growth phase, eventually at some point, one would expect to see oil demand per capita rise pretty significantly And if not China, maybe you end up with various other Southeast Asian and other sort of emerging market countries where you see that significant step up, continuing that very long term trend of 1% plus global demand growth. So basically, the takeaway from that is that demand continues to grow, high level, big picture. Supply continues to be anemic, and there's been persistent underinvestment, which has historically led to much higher prices in that sort of quad type approach or cyclical type approach that we illustrated. There have been dozens of those sorts of oil cycles over the history of commercial oil consumption over the last 100 plus years. And so our position on this is that this time is likely not different. And actually, the very bearish headlines that you see are, we think, actually better for sort of signaling where we are in the cycle rather than being helpful as sort of you know indicators of truth that somehow New York Times or Bloomberg or whatever knows when the world has peaked from an oil consumption perspective. I think it's helpful to look at the history of various publications and see that The Economist and New York Times and so on have been really good at having headlines about oil consumption peaking at prior down periods, sometimes at the very bottom, sometimes sort of near the bottom or coming out of the bottom of various prior oil cycles. So I think when you look at that, it's actually quite promising and exciting to see those headlines, but it's easy to get caught up in it. And frankly, they say bull markets take as few as possible with them. So from a oil price versus inventory perspective, there's been a pretty big disconnect. There was just a great report that came out arguing that this disconnect is, I think they were sort of arguing it was permanent, which seems like crazy because these are physical commodities. So when you have supply and demand imbalance in oil, you end up either building up or depleting global inventories. And so whether it's oil or refined oil products or some combination. And so there was a pretty big disconnect in between the inventory levels and price levels earlier this year, frankly, even like a month and a half ago. That disconnect has closed quite a bit from this elevated geopolitical risk, and there's still room for another $10 to $15 a barrel of that sort of reconnect back up to what looks like closer to fair value based on this sort of analytical approach from a comparative inventory perspective. So lots of sort of fundamental upside, along with weird narratives around supply and demand becoming irrelevant. Those sorts of things, from my perspective, are amazing red flags that are really, really good signposts to go and buy more of whatever it is that people are saying that basic economics no longer apply to. And there's this nonsense narrative about natural resources economics are not real economics, or they're different, and therefore different rules apply. And the reality is, if you produce more than you consume of something, the price will fall. If you produce less than you consume of something over time, the price will rise. And the ability for there to be low cost producers or to build up inventories or so on just means that the pain from over or under production can be deferred for periods of time. But in the end, in a physical commodity, ultimately supply and demand do matter and do ultimately over time translate to price. And whether it's through geopolitical risks and uncertainties, or whether it's through actual physical shortages or actual physical surpluses to the point of full supply tanks like we saw in 2020, or risk of full tanks and negative prices, through both of those, there are these very powerful physical forces that affect prices. And we were getting to a point where inventories were falling dangerously and prices were also falling. And you sort of needed one of those to get fixed. And it looks like we're getting fixed via higher prices, at least for now. So there was a lot of discussion up until yesterday about OPEC and OPEC Plus and what they were doing, and I think it's helpful to think about this in this context. We put out a call that got a lot of flack on this setup being similar to 2018, where OPEC was bringing oil back on the market to be able to facilitate the U.S. or Israel. And basically, I don't know, we didn't know exactly who, but it seemed clear that OPEC was sort of prepping the market for potential supply losses. And so, similar to 2018, where Saudi Arabia and various OPEC countries brought more oil onto the market, and then Iranian supplies were cut off, like we showed in that earlier chart. We've seen OPEC start to bring oil back onto the market. OPEC sees the market as actually quite tight, or saw it as quite tight, at least in Q1 before Liberation Day and some of the tariff issues. And so it's pretty interesting to see sort of how they viewed it and how they were sort of messaging their increases in oil supplies, especially in the context of now increased oil geopolitical risk and potential supply disruptions, particularly from Iran. So they showed strong demand, growing demand, weak supplies, and lower than average inventory levels. And so their argument for increased OPEC supplies, OPEC plus supplies, was purely fundamental. And whether it was truly fundamental, or whether they had some idea that there was going to be some sort of supply disruption, or if they were just reacting to the risk of a potential supply disruption, it does look like that. It almost doesn't matter what the motivation was. It did set up very nicely for this, and it could be a reason why oil prices are up right now, $3 to $5 rather than $30 to $50. And I would argue that to the extent that we see some real larger supply disruptions, we could get back into that sort of much larger oil price move territory. Um, so OPEC increased their paper barrels a lot more than they increased their actual supplies so far, and they were having an issue where their member countries had put out some spare capacity estimates, which were suppressing oil price, like we showed in prior charts. Oil inventories were falling, but prices were also falling. It looks like at least part of the narrative on that was driven by futures market positioning and speculative interest, because clearly it wasn't fundamentals due to that disconnect between price and inventory levels. So it looks like one of the things they were trying to solve was by increasing quotas without necessarily increasing actual production. They were reducing the measured spare capacity of their constituent countries. It's amazing to us how many people get this stuff wrong. And I guess one thing I found interesting that I've actually got clarified from the head of research from OPEC was that OPEC doesn't actually publish spare capacity estimates for their members. OPEC members just publish their own estimates. OPEC doesn't go and doesn't verify that. They may be starting to do that in 2027, but they don't currently. And when I shared Bison's analysis on this work, on this question with their head of research, they actually thought that our approach was pretty reasonable, and that our estimate of 2 to 3 million barrels a day of spare capacity was much more reasonable and rational than the stated spare capacity numbers from OPEC plus countries that are measured. I think I saw a research firm come out with something today claiming 7+ million barrels a day of spare capacity. So they actually thought ours seem more reasonable. And I think that matters a lot, because this concept of spare capacity and this misconception that these countries can rapidly grow their production on short notice as sort of this emergency escape valve, I think the quantum of that available production is much lower than the market thinks. And I think OPEC thinks that too. And there was some interesting messaging around that recently from various energy consultants, messaged reportedly by some of the various energy ministers and so on within OPEC, along with news headlines like from Russia, where Russia has been unable so far to increase their production in line with their increased quotas. So again, there's some real world evidence of some of these theories. Why does all this matter? Because if you could potentially lose 2 million barrels a day, but you have 7 million barrels a day of spare capacity, then that may actually not matter. If you could potentially lose 2 million barrels a day of production, and you only have 2 or 3 million barrels a day of spare capacity, you could get into a situation really quick, especially when you incorporate demand growth, where we're mid-year. So if you're growing demand by 1 million+ barrels a day every year, like you saw in the first quarter, you actually could be net, if you thought you had 2 or 3 million barrels a day of spare capacity, but demand has already grown, let's say 500,000 barrels a day, and you only had 2, and then you lose 2 of from Iran, you could actually be undersupplied by 500,000 barrels a day, and that would be growing, not shrinking, because you'd have this sort of structural demand growth at a time where rigs were falling. So again, that's why this matters. I might have lost you with this, but the idea is basically spare capacity matters. OPEC was killing some of the paper spare capacity through their aggressive output increases while also giving room to potentially cut off Iranian production. They won't say it, they won't admit it, but it looks a lot like 2018. And there's room in the market right now for Iranian production to get cut off based on OPEC plus quota increases. And there's also room for some of the spare capacity to get written down. So, this was a Raymond James analysis. I actually got to see Marshall Atkins recently at a conference, and we got to chat. I think his number is a little higher than this right now, but still, lower than way lower than some of the numbers from um, the different OPEC countries and the various energy consulting firms and so on. And so, again, this matters. It sounds like it's very esoteric, but this matters a lot in the context of potential to lose barrels from the market, whether it's sanctions on Iran that are more strictly enforced, or whether it's Iran hitting some of the other supply lines, like potentially shutting or reducing supplies from the Strait of Hormuz, or elevating attacks by the Houthis, or Israel attacking Iranian oil export infrastructure, or so on. So, I thought this was worth highlighting, and I think this analysis and these questions around spare capacity could come way back into the forefront, especially if there are any supply challenges or losses as this situation in the Middle East develops and evolves. Okay, so here's the fun part from my perspective. So what we do at Bison is invest in small publicly traded oil and gas companies. Here's an example of one. We pulled this from a co-investment presentation where we've been raising some money. This is not an offer or solicitation, but we've been raising some money to go buy a bunch of oil stock where their production is outperforming and they're rapidly paying off their debt. And we use this other company we talked about a few years ago as an example, where they're aggressively paying off their debt and they're getting better results than expected. And that can end up driving way outsized returns versus the comp set and the index, as well as just sort of very attractive absolute returns. We think there is a number of opportunities like this in the smaller cap oil and gas space, both on the upstream producer side as well as on the services side. And we think that these things actually have a lot of sort of right tail oil price exposure, while also having some left tail risk mitigation, because if you're improving your well productivity and you're paying off your debt, you're lowering your oil price break even. And the market often sort of gets that analysis wrong in the short term, because people don't want to do the work. And there's typically very poor research coverage on smaller companies that historically underperform. So there's this really interesting opportunity set. And we're not perfect. It's not like we got the very, very top when we exited on Baytex, and we did on this one, rather than going to raise more money to buy it, we just wrote about it, which is not the Bison profit maximizing approach, but it was fun and interesting from a reputational perspective to go on TV and write these articles about sort of what we had found with their oil discoveries, and to have a public multi-100% return on a specific kind of position. But anyway, there's a whole set of these, and I think right now the oil market's really similar from an equity perspective in small caps to that sort of late 2020, early 21 type opportunity set. There's various companies where they'll be pretty similar to peers, but they'll trade at large discounts to production values and cash flows and free cash flow. And none of these measures are great on their own. Each of them have their own challenges and opportunities. But when you look at them in aggregate, you can get sort of a matrix or a sort of a blended view on companies, and find ones that are really extraordinarily cheap, and should also have some significant risk mitigation. And so we're really excited about what we're seeing here. And the amazing thing is, this is in a sort of $60 or $70 oil price environment. There's enormous right tail upside potential to some of these companies, especially if you're buying production at a low value per flowing barrel and buying cash flow at a low valuation metric, there's really extraordinary potential returns on some of these, especially if the oil market sort of progresses how we think it could. If right tail risk plays out from an oil price perspective, there's room for these 2 times EBITDA companies to actually be 1 times EBITDA because they have a higher oil price. And then if they have a bunch of debt, there's room for their equity to go up 5x or 10x or something, when some of their peers with less debt and higher valuations might go up 30 or 50% or something like that. And like we showed at the beginning, our history is that we haven't always been able to catch that, but over time we've way outperformed our index at Bison. We outperformed the smaller cap public oil and gas peer set, and frankly even the large cap one, by finding companies like this and investing in them and benefiting from outsized returns relative to, in some cases, mitigated risk. Again, there's no guarantees on this. Past performance may not be indicative, but there's really exciting, really interesting valuation disconnects on an individual idiosyncratic security basis, which is where we spend almost all of our time. And then, similar, there's transactions that imply really high values for our companies. We put out analyses on these on a number of different specific companies. And the idea isn't that they always lead to sales or exits at that sort of price. It's that they're really helpful from a compass perspective to tell us, sort of similar to, hey, our rig's declining. Is the rig count falling a lot? Okay, that probably means we're in this low price environment. And it's probably a really attractive opportunity to be deploying capital because valuations are likely low. And there's lots of upside as production falls from lower activity and ultimately prices rise. Similar, if you can buy companies, in our experience, at large discounts to recent transactions on assets that are very similar in their area, there's often room to be able to capitalize on revaluations higher, and or liquidations. And it's just another very helpful metric, along with EBITDA multiples and flowing barrel valuation multiples and free cash flow yields and so on. It's just another metric that's really helpful. And for us, it gives us an idea of, hey, are we in a premium environment for public equities on the small cap side, or are we at a discount? And right now we're at big discounts, with some of these companies trading at just absolutely ridiculous implied returns from a liquidation value perspective. So when we zoom out just a little bit, I think there's a really good shot this cycle where we could see these small caps and services outperform not just the larger caps, which have also done poorly, just less poorly, and actually materially outperform the overall market and catch up to the point where they induce enough generalist investment and broader market participation to actually get enough investment to oversupply the market again, to get into that high price environment spot, which would then ultimately glut the market and send prices lower again. If you look at the period from 2001 to 2014, you saw significant outperformance, particularly by smaller cap oil and gas stocks, particularly for that first roughly 7-year period. The 2001 to 2008 period was astonishingly good for small cap public oil and gas companies and for oil field services companies. And those were companies that had done very poorly in the prior 10-year period. And so again, and they way outperformed the stock market in that time frame. They made up for a lot of the lost ground from that prior 10-year period. And here we are in a very, very similar setup with these companies at large discounts to their intrinsic value, at large discounts to larger oil and gas producers, and at crazy discounts, in my view, versus the broader market. And again, I think one of the easy ways to tell that we're there from a sentiment perspective and that these things are not being taken seriously from a valuation perspective or from a market participant perspective is just to look at how people are reacting to this manifestation of oil supply geopolitical risk. And the number of people out there who are ostensibly experts, whatever, that said this wouldn't happen and then it happened and now say it won't matter, virtually the entire competitor set for Bison, almost every private fund manager, various other folks that have sort of a platform publicly are saying this, and the media folks are saying this. And maybe it's true, right? Maybe there won't be an escalation and maybe oil prices will fall on the backside of this. It is possible. There's a scenario where that happens. I don't think it's very likely, but it's possible. But I think the scarcity of folks that are making the call that, hey, this is different than 2019 and then 2023 and 2024, which I think the scarcity of that, especially from fund managers, from investment bank analysts, from energy consulting firms, and so on, I think helps you see sort of where sentiment is for the sector and just how bad things have been broadly. And yes, there's always individual exceptions. Frankly, we're up 30% net versus PSE down 70 something percent net. Since was it actually? I think it's down 70% since 2015, May of 2015 when we launched. So obviously we've been able to catch some of those that have materially outperformed, but this broad basket is helpful, especially on the small cap side and the services side, to understand just how poorly the aggregate has done. And I think that poor performance has driven and reinforced repeatedly and effectively sentiment and capital allocation. And so what cures this and gets us back into an upcycle is much higher prices and scarcity. And whether it's a geopolitical event or whether it's just the cumulative effect of underinvestment in long cycle reserve replacement and reserve assessment projects, in the end, you end up with much higher prices for these equities and much higher commodity prices and material outperformance versus the broader market. This is not the first oil cycle. This is not even the 10th oil cycle. And almost everyone looking back has looked like how I'm describing it. So it's possible this time's different. It's possible that we've seen the end of oil. It's possible that the per capita consumption of oil in China will just always remain at a fifth of Western levels. But I will take that bet. I think these things do really well from here. I think that Chinese and Indian and various other emerging market countries will see rapid demand growth for oil on a per capita basis, and that it will overwhelm declining per capita consumption in countries like the US, and that we'll see a continuation of this 1% plus global oil demand growth over the next decade, and that we may see these underperforming indexes catch up and then some, and that some of these individual securities that are trading at even larger discounts that are poorly understood, especially ones that are achieving better results and that haven't yet been priced into the market to benefit from those results from a share price improvement perspective. I think those are sort of the most attractive, and there's room for sort of individual companies' shares to go up many times what these indexes could, and these indexes could outperform the broader stock market by quite a bit. I get that this sounds absolutely ludicrous and it's very difficult to hear. And I've chatted with fund managers and other folks that were actually deploying capital in the early 2000s, and I've listened to interviews and read books by folks that were deploying capital in the late 1960s and early 1970s, and really, like, there's a very similar feeling. There's a very similar set of challenges, and I couldn't be more excited to go deploy capital into this environment. And days like today, where there's big events and everyone just absolutely lines up to talk about how bearish it is and how this is the peak for oil and the peak for oil and gas stocks, when virtually all cases they did not predict it, they did not forecast it, they were already bearish oil, they already thought there were various issues, and they were sort of on this very sort of consensus position. Almost all of the analysts and fund managers and industry experts or whatever and consultants and so on, pundits on TV, almost everyone's on one side of this boat. And now they're just on this, in addition, they've moved from the nothing ever happens position to the nothing ever happens that matters position. And so, I think it's a really attractive bet to take when almost everyone's taking that bet to take the other side of it. And so that's why I thought it made sense to do this and sort of share my view and our view at Bison, and to share some of the kinds of specific opportunities that we're seeing for potential massive outperformance, as well as some of the data on the oil market and oil supply demand balances, as well as oil price dynamics that are driving the current market, as well as driving the current extreme negative sentiment. And the reality is, if you look at this chart and say, hey, there's people who focus on these things on the bottom, guess if they're bearish or bullish, like the right answer would be that they'd all be bearish because they would have just suffered a decade plus of pain. And we named the firm Bison because we knew it was going to be painful and volatile, and we faced into the storm. And so far, that's been to our benefit and our clients' benefit, at least relative to these underperforming indexes. And we think over time, and we're hopeful over time, that it will be like past cycles, which there is no guarantee for that, but that it will be like past cycles, that we'll see small cap oil and gas equities massively outperform versus the market from here. So with that, I'm going to turn off the recording and open this up for questions. Thank you again for your time.